What's going on, guys? Gabe with ReviewDork, and today's your day trading video. And what I'm going to do is debunk the biggest lie and fallacy that's being taught to you as a trader, lowering your average cost. This makes sense for value investors that have a long-term time horizon. Obviously, you want the discounts and you have conviction in stock and you plan on holding it over time. Yes, over time, our economy is constantly on an uptick. So yes, over time, you will make money, but we're not dealing with time. Why? Because time is money and we want to make money now. So let's talk about the biggest fallacy in day trading. Why averaging down is a bad investment strategy. Now, you're in a trade, you're in a day trade, you probably just bought up a daily runner. And guys, I did that today. I make a lot of my money in the pre-market. And the only reason why I was able to make some money is because I believe in stop losses and not average downs. So let's get right to it. We're going to go ahead and look at Webull. And this video is brought to you by GOVX. I know you guys saw this running in pre-market and you probably jumped into it. Before we continue, Applejacks, you go ahead and you buy 100 shares for $100. And then you go ahead and you buy another 100 shares because it dipped and you bought it for $50. What's your average?
I believe that's 75.
Yeah, that's 75. So if you set your stop loss to 90, you only lose $10. However, if you average down to 50, well, you're in a world of hurt because you don't know if that equity is going to keep dipping. So the only thing that is sure in the stock market is the stock goes down and it goes up. The thing that is variable is when you enter and when you sell. So let's go ahead and look at the chart here. Now, let me explain the anatomy of my decision making. As you guys can see here, we have some consolidation in the pre-market and we could see that GOVX was consolidating at about 730, 740. Now, I like to invest with optimism. It's going to go up. That's my mentality. I went ahead and purchased the equity at $7.30. I also protected my investment, but also knew that pre-market is a very volatile time. I have a hard stop loss at $7.10. That's a 20-cent loss. Well, I got stopped out really quick, guys, because yeah, we went all the way down, as you guys can see here at the end of this highlighted box. That was a bad decision for me. Now, I could have carried that all the way over to market open, in which we saw a dip, but no, I exited my position. So I only lost 20 cents per share. 2,000 shares, that's $400. You live to die another day. Here we go. I see the equity at open. It dips. This is very common when the market opens. People are taking their profits. Now, I see it dip to a very significant level. We have the significant level here being about 660. Now, how did I find the significant level? Well, I went ahead and went into pre-market and saw levels of consolidation where the price bounced off the level of support. Guys, this is why support and resistance is everything when you're plotting your entries and your exits. I went ahead, I entered at 660 and I exited right here, as you guys could see, at 708. That's a 48-cent spread. I lost 20 cents on the first. I made 48 cents on my second entry. So I'm 28 cents profit. How did I come to the conclusion? Well, I saw a bounce off of support and then I saw resistance, and I didn't exit immediately here, but I saw an opportunity. It was going to keep going up until it reached 708. Let me explain the importance of this. We do have an average down calculator, and I just threw some numbers in there. If I entered at 730 and then I re-entered again at 659, my average cost would be $6.94, meaning if I average down at 660, I would have to run up 34 whole fucking cents just to break even. Where does that leave me? That leaves me with a profit margin of at or about 14 cents. That's not what I'm here for, guys. My goal here on a daily basis is to make between $500 and $1,000 a day. And if I could do that in one trade, then I do it in one trade. I get the hell off and then we start filming videos. So the importance of this, you have to understand, you always want to limit your losses and then find better entry points, because averaging down is pretty much wasting good money after bad, especially when you do not know how far down the equity is going to go. By having a stop loss, that was the difference between making 14 cents a share or 280 bucks versus damn near 40 cents a share or $800. Well, actually my realized profit was more about 405 bucks, but don't dig yourself deeper into the hole. There's plenty of opportunities throughout the day to make money. We also see the equity presents itself with another opportunity as it dips to $5.93. You enter and then you have your stop loss set at $5.80. For the guy who entered at $5.93, you currently have been handsomely rewarded. You take your profits, you get the hell out. You hold on to a position too long, guys, you're being greedy. Trading is all about small wins that compile into a bigger win. Not big wins, big wins, big wins. This is how you stay realistic. This is how you stay humble. And this is how you keep emotions out. Because guys, if you go ahead and you average down, that is like desperation. Now you're like, oh my God, what did I just do? Why is it going down? Do I have to average down some more? And then you just keep digging yourself a bigger hole. So stop averaging down, set stop limits, limit your orders, get the hell out when you see profit and make it fucking happen. That's simple. This is Gabe. I'm signing out. Peace.